Stop scrolling right now. If you're over 65 and you've already filed your taxes or you're about to file, listen to this. The IRS might owe you thousands of dollars at this very moment. And here's the thing. Most seniors have absolutely no clue this money is sitting there waiting for them. A brand new rule just went into effect this tax season. Miss it, and that money vanishes forever. I'm Michael, and by the time you finish watching this video, you'll know exactly how to claim up to $6,000, or $12,000 if you're married, without changing a single other thing on your tax return. Don't skip ahead, because later, I'm going to show you the exact spot where people are making critical mistakes. That one error alone is costing seniors hundreds, sometimes thousands of dollars this year. Let's start from the beginning and look at the big picture here. Every year, Americans file their taxes. If you're over 65, you're probably filing on income from Social Security, maybe a pension, retirement account withdrawals, some investment income, possibly a part-time job or side income. The IRS handles your taxes based on something called your taxable income. Think of it this way. It's the money you earned minus the deductions you're allowed to take. More deductions means lower taxable income. Lower taxable income means less tax you owe. That's the foundation of how this entire system works. And that's exactly why what the IRS just changed is such a massive deal for people like you and me. Here's what you absolutely need to know. Thanks to a new law called the One Big Beautiful Bill Act, passed by Congress and signed into law in 2025, there's now a brand new extra tax deduction available specifically for people who are 65 or older. They're calling it the Senior Bonus Deduction, and it's worth $6,000 per person. If you're married and both you and your spouse are 65 or older, you can potentially claim $12,000 with this new deduction, $6,000 each. This is on top of everything else you were already eligible for. It's not replacing anything. It's a completely new additional amount that gets subtracted from your taxable income. And here's the part that really gets people excited. It doesn't matter whether you take the standard deduction or whether you itemize. Either way, you can still claim the $6,000 senior bonus. That's rare, and that's huge. Now let's talk about who exactly qualifies for this new $6,000 deduction, because there are some specific rules you need to understand. First, you must be 65 years old or older by December 31st of 2025. If your 65th birthday was January 1st of 2026 or later, you don't qualify for this particular tax year. So we're talking about the 2025 tax return, which you're filing right now in early 2026. Second, there's an income limit. If you're a single filer, your modified adjusted gross income, which most people just call your total income before most deductions, must be under $75,000 to get the full $6,000. If your income is above that, the deduction slowly starts to phase out and get smaller. For married couples filing jointly, the income limit is $150,000 combined. However, some sources indicate there may be higher phase-out limits depending on your filing status and specific eligibility. So it's worth double-checking with a tax professional or using good tax software to make sure you're getting every dollar you deserve. The point is, for the vast majority of retirees in America who are living on Social Security, pension income, and modest retirement account withdrawals, you very likely qualify for this deduction in full, or at least in part. Now here's something I really want you to understand, because I think this is going to make it all click for you. Let's use a simple example. Imagine a woman named Barbara. She's 68 years old, single, and she receives $20,000 a year in Social Security benefits. About 85% of that, so roughly $17,000, is considered taxable. She also gets $13,000 a year from a small pension, so her total taxable income before deductions is about $30,000. Under the old rules, she would take the standard deduction for someone her age, which is already pretty generous. But now, with this new $6,000 senior bonus deduction on top, her taxable income drops significantly. Instead of owing taxes on $30,000 worth of income, she might only be taxed on much less than that. The result? Her federal tax bill goes down by hundreds of dollars, potentially around $700 or more. For a retiree living on a fixed income, that's real money. That's grocery money. That's prescription money. That's money for the grandkids. and Barbara doesn't have to do anything special to claim it. She just has to make sure her tax software or her tax preparer knows about this new rule and applies it correctly. Let's keep going because there's more you need to know. In addition to this brand new $6,000 deduction, there are also increases to the regular standard deduction that apply to everyone, including seniors. The standard deduction is the flat amount the IRS lets you deduct from your income without having to prove any specific expenses. For the 2025 tax year, the standard deduction for a single person who is 65 or older is quite substantial. When you add the base standard deduction to the additional age-based deduction that seniors have always been entitled to, plus this new $6,000 bonus, the total amount that a senior can deduct from their income is historically high. For a married couple where both spouses are 65 or older, the combined total of all these deductions stacked together can be close to or even exceeding $46,000. Think about what that means. It means that if your combined income is below that threshold, you may not owe any federal income tax at all, and even if your income is above that, you're going to owe significantly less than you did in previous years. Now, I want to spend a moment talking about something that's tripping up a lot of seniors this filing season, and that's the question of whether to itemize or take the standard deduction. For decades, a lot of people would itemize their deductions, meaning they would list out every single deductible expense: mortgage interest, charitable donations, medical expenses, property taxes, and so on, because the total of all those things added up to more than the standard deduction. But here's the thing. With these new higher deduction amounts, the math has changed for most retirees. If you've already paid off your home, you don't have mortgage interest to deduct. Without mortgage interest, it becomes very hard for the average senior to rack up enough itemized deductions to beat the new higher standard deduction. So this year, many people who have been itemizing for 20 or 30 years are going to find that just taking the standard deduction, including all the senior bonuses, gives them a better result. Don't assume that just because you've always itemized, you should continue to do so. Run the numbers or let your tax software run them for you. In most cases for retirees in 2026, the standard deduction with the senior bonus wins. The only situation where you might still beat the standard deduction by itemizing is if you had very large medical expenses last year. The IRS lets you deduct medical costs that exceed 7.5% of your adjusted gross income. So, if your adjusted gross income is $50,000, you can only deduct medical expenses that go above $3,750. If you had a major surgery, a long hospital stay, significant dental work, hearing aids, or other big health expenses, you might clear that threshold by enough to make itemizing worth it. But for most seniors with typical medical costs, even those expenses usually don't push you past the new higher standard deduction. If you're not sure, ask a tax professional or use software that automatically compares both options for you. Let's talk about something else that's new this season that every retiree needs to be aware of. New and updated tax forms. The IRS has specific forms for seniors, and using the right one matters. There's a form called the 1040-SR, which stands for U.S. Tax Return for Seniors. It has bigger print, it's easier to read, and it includes a built-in chart specifically for calculating the senior standard deduction. If you're 65 or older and you file a paper return, make absolutely sure you're using Form 1040-SR and not the regular 1040. It has a specific checkbox for people who are 65 or older, and checking that box is what triggers the age-based deductions you're entitled to. If you file electronically, which most tax software handles automatically, the software should detect your age and apply the right deductions for you. But always double-check. There's also a new schedule or form required to claim the brand new $6,000 senior bonus deduction. You can't just write in the $6,000 on your main form without the proper supporting documentation or the correct line item. This is where some people are making mistakes this season. If your tax software doesn't automatically include this new deduction because it hasn't been fully updated, or if you're filing by hand, you need to make sure this gets included properly. This is one of the biggest reasons I would strongly encourage any senior who's not confident about filing to use a reputable tax software program or visit a free tax preparation site this year. The rules are new enough that you want to make sure nothing gets missed. Now let's talk about free tax help, because this is something a lot of people don't know is available to them. The AARP Foundation runs a program called TaxAid, and it's completely free. They have thousands of locations all across the country. Libraries, shopping malls, banks, community centers, senior centers. Trained volunteers who specialize in senior tax issues will sit down with you, go through your documents, and prepare your return at no charge. All you have to do is go to aarp.org/tax or call 1-888-AARP now to find a location near you. This service is available during tax season, and the volunteers are specifically trained on the rules that affect seniors, which means they'll know about the new $6,000 deduction, the updated standard deduction amounts, and all the other changes we're talking about today. There's also a program called IRS Free File. If your income was under $89,000 in 2025, you can use guided tax software completely free through the IRS website to prepare and electronically file your federal tax return. You don't have to pay a tax preparation company anything. You go to irs.gov, click on Free File, and you get access to professional-grade software at no cost. If your income was above that level, you can still use something called Free File Fillable Forms, which is a more basic option, but still free for everyone regardless of income. Now let's talk about Social Security and taxes, because this is a question I get asked all the time. Yes, your Social Security benefits can be taxable, and this trips up a lot of seniors who assume that Social Security is completely tax-free. Here's how it works. If you file as a single person and your combined income, which is your adjusted gross income plus non-taxable interest plus half of your Social Security benefits, is between $25,000 and $34,000, then up to 50% of your Social Security may be taxable. If that combined income is above $34,000, up to 85% of your Social Security benefits can be taxed. For married couples filing jointly, the threshold is $32,000 to $44,000 for the 50% level, and above $44,000 for the 85% level. Now, the good news is that the new $6,000 senior bonus deduction can help offset some or all of that tax. For lower-income seniors, this new deduction might effectively eliminate federal taxes on their Social Security income entirely, which is a huge relief. One thing I want to make very clear is that just because your Social Security is taxable at the federal level doesn't necessarily mean you owe state taxes on it. Many states don't tax Social Security benefits at all, so your state tax bill and your federal tax bill are two completely separate calculations. If you're not sure about your state, look up your state's rules or ask a local tax preparer. Let's also spend some time talking about required minimum distributions, or RMDs, because this is something every retiree with a traditional IRA, a 401k, or similar retirement account absolutely must understand. Once you turn 73, the IRS requires you to take a minimum amount of money out of those accounts every year, whether you need the money or not. That withdrawal is called your required minimum distribution, and it's fully taxable as ordinary income. If you fail to take your RMD by the deadline, which for most people is December 31st, the penalty is very steep. The IRS can charge you an excise tax of 25% of the amount you were supposed to take out but didn't. That's a massive penalty that you absolutely want to avoid. Here's how this connects to the new deductions. When you take your RMD, that money gets added to your taxable income. But with the new $6,000 senior deduction on top of the already generous standard deduction, some of that RMD income may be offset, reducing your total tax bill. Smart retirees are working with tax advisors to figure out how to manage their RMDs in a way that keeps their income low enough to qualify for the full $6,000 deduction while still taking out enough to satisfy the IRS requirement. It's a balancing act, but it's worth thinking about. Something else that's gaining attention this tax season is a strategy called a Roth conversion. A Roth conversion means you take money from a traditional IRA, where the money has never been taxed, and move it into a Roth IRA, where future growth and withdrawals will be tax-free. When you do a Roth conversion, you owe income tax on the amount you convert in the year you do it. But here's where it gets interesting. With the new higher deductions available to seniors in 2026, some people have what's called unused deduction space. If your total deductions, the standard deduction, the age-based deductions, and the new $6,000 senior bonus add up to more than your current income, you could potentially convert some money from a traditional IRA to a Roth IRA and pay little to no tax on it. This can be an incredibly powerful long-term tax planning move, especially if you expect tax rates to go up in the future or if you want to leave tax-free money to your children or grandchildren. But this is the kind of move you really should talk through with a qualified financial advisor or CPA before doing, because it's not right for everyone. Now let me talk about something that's very relevant for the many retirees who have picked up a side job or gig work in recent years to help cover rising costs. If you earn $600 or more from any single client or company as an independent contractor, that includes things like driving for a rideshare service, doing freelance work, consulting, selling crafts, or any other self-employed activity, you'll receive a form called a 1099 NEC. NEC stands for non-employee compensation. This income is treated very differently than wages from a regular job. It's subject to something called self-employment tax, which is currently 15.3%. This catches a lot of retirees completely off guard because they're used to having taxes automatically withheld from their income. When you work as a contractor, nothing is withheld. It's your responsibility to report and pay the taxes yourself. The good news is that you can also deduct business expenses related to that work, which reduces how much of that income is taxable. But you must report it on Schedule C, not just stick it in with your regular wages. Getting this wrong is one of the most common mistakes seniors make on their returns this year. There's also the matter of selling things online. In recent years, the IRS has significantly lowered the reporting threshold for online sales platforms. If you sold items on eBay, Facebook Marketplace, Etsy, or any similar platform, and you received $600 or more in total payments, that platform is now required to send you a form called a 1099-K and also report it to the IRS. A lot of retirees who sold old furniture, collectibles, jewelry, or other belongings online are receiving these forms for the first time and are confused about what to do. Here's the key thing to understand. Not all of this money is necessarily taxable. If you sold personal items for less than you originally paid for them, that's considered a loss and you generally don't owe tax on it, but you still need to report it correctly on your tax return. If you just ignore the 1099-K, the IRS computer system will flag your return because their records show income that yours doesn't. That can trigger a notice, a delay in your refund, or even an audit. Speaking of audits, let me take a moment to talk about some common red flags that can trigger extra scrutiny from the IRS for senior filers this year. The number one thing to understand is what's called the matching rule. Every 1099, every W-2, every statement you receive, the IRS gets a copy too. Their computers automatically match what's on your return against what was reported to them by banks, brokers, employers, and Social Security. If something doesn't match, it will be flagged automatically. This is why it's so important to report everything accurately and to include every form you receive. If you got a form in the mail, assume the IRS has the same information and make sure your return reflects it. Another common issue is IRA contributions. If you contributed money to an IRA but you didn't have any earned income, meaning you were living only on Social Security and pension payments, not actually working, you may not be eligible to contribute to an IRA at all. Contributing when you're not eligible results in what's called an excess contribution, which carries penalties. Let's also quickly discuss something important for those who pay household workers. If you hired a caregiver, a home health aide, a housekeeper, or any other domestic worker, and paid them more than $2,700 in 2025, you're technically their employer in the eyes of the IRS. That means you may be required to pay what's called the household employment tax, also known as the nanny tax, and file Schedule H with your return. This rule applies even if the person is part-time, even if they're a family friend, and even if you paid them in cash. If you paid someone to help you or a family member at home, and they later file for unemployment benefits and list you as their employer, the IRS and your state unemployment agency will compare records. If you didn't file Schedule H, you'll receive a notice. Now I want to circle back to something really important, and that's the timeline. The tax deadline for most Americans is April 15th of 2026. That means you have until April 15th to file your federal income tax return. If you need more time, you can request an extension, which gives you until October 15th. But here's the critical thing most people don't realize. An extension to file is not an extension to pay. If you think you're going to owe money, you still need to estimate that amount and pay it by April 15th, or you'll owe interest and possibly penalties on whatever is late. If you receive a refund, the best way to get it fast is to file electronically and choose direct deposit. The IRS typically processes electronic returns and sends refunds within 21 days. Paper returns take much longer, sometimes 6 to 8 weeks or even more. With all the new rules and changes this season, there may also be some processing delays, so the sooner you file, the better. Don't wait until the last minute. I also want to mention that if you have a Social Security account, you can go online to ssa.gov and set up what's called a My Social Security account. Through this account, you can get a replacement copy of your SSA 1099 form, the form that shows how much Social Security you received last year, without having to wait for it to come in the mail or call a phone number and wait on hold. This is a huge time saver, especially if you misplace the form or it never arrived. You can also use this account to check your Social Security earnings history, verify your benefit amounts, and manage other important information. Here's the bottom line that I really want you to walk away from this video understanding. This tax season is genuinely different from previous years, especially for seniors and retirees. The new $6,000 senior bonus deduction is the biggest change, and it has the potential to save you real money. But you have to claim it. It doesn't happen automatically just because you exist and you're 65. You have to file a return and make sure that deduction is included. You also need to make sure you're using the right forms, reporting all your income correctly, including gig work and online sales, and taking advantage of free resources if you need help. Whether you use a reputable tax software program, visit an AARP tax aid site, or work with a local CPA or enrolled agent, please don't just assume your taxes are the same as they were last year and file the same old way without thinking about it. This year is different. The rules are different. And if you file the same old way without accounting for these changes, you might leave a significant amount of money on the table. Please share this video with anyone you know who's retired or getting close to retirement age. Parents, grandparents, neighbors, friends. Everyone who's over 65 needs to know that there's a new $6,000 deduction available to them right now. Most of them have no idea it exists, and the news isn't doing nearly enough to spread the word. You can be the person who makes sure someone in your life doesn't miss out on money they're entitled to. If you found this helpful, please give it a thumbs up and consider subscribing to Michael Visa Guide so you don't miss future videos on topics like this. I'm Michael. Thank you so much for watching. Take good care of yourselves, and good luck with your taxes this year.